One word changed. That's all it took. Buried inside a routine policy statement released this week, a single phrase was quietly swapped for another. Most people scrolling past the headline never noticed, but traders who read these statements for a living noticed immediately. And within minutes, gold moved. This wasn't a rate cut. It wasn't a surprise announcement. It was a change in language so small that most financial outlets didn't even mention it in their coverage. But language like this is never accidental. Every word in an official policy statement is chosen, reviewed, and debated long before it's ever read aloud. When one of those words changes, it means something changed behind closed doors first. By the end of this video, you'll know exactly which word shifted, why it matters more than it looks, and what the market is already quietly pricing in because of it. Welcome back to Gold and Silver Analysts, the channel where we dig past the headlines and show you what's actually moving your money. If you're new here, consider hitting that subscribe button. It's how you make sure you don't miss the next shift before everyone else catches on. And we'd love to know where you're tuning in from today. Drop your city or country in the comments below. It's always incredible to see how far this community reaches. Now, let's get into it. The statement in question was released this week following a routine policy meeting. On the surface, it read like dozens of statements before it. Measured, cautious, deliberately unremarkable. But buried in the third paragraph was a shift that changed the entire tone of the document. In previous statements, officials had consistently described economic risks as balanced. This time, that word was replaced with tilted. A small change. 6 letters different. But in the language of central banking, that shift carries enormous weight. Balanced tells markets that policymakers see roughly equal odds of the economy overheating or slowing down. Tilted tells markets something has shifted, that risks are no longer sitting evenly on both sides of the scale. It signals, without saying so directly, that officials are now more concerned about one outcome than the other. And when that concern points toward economic weakness rather than inflation, it usually means one thing. Rate cuts are moving closer, not further away. Gold responded almost immediately. Within the first hour of the statement's release, prices climbed nearly 2%, pushing past a resistance level that had held for the better part of 3 weeks. Silver followed a similar path, gaining ground alongside it. Neither move was explosive on its own. But for a market that had spent weeks trading sideways, waiting for a catalyst, this was exactly the kind of quiet signal traders had been watching for. What makes this moment worth examining closely isn't the size of the price move. It's the fact that almost nothing else changed. No emergency meeting was called. No major economic data was released that same day. The only thing that shifted was language. Carefully chosen, deliberately reviewed language, inside a document written by people who understand exactly how closely markets will scrutinize every syllable. That's the first thread in this story, a wording change with real consequences. The second thread is less visible, but arguably more important, the reason behind the shift, and what it reveals about what officials are seeing in the data that the public hasn't fully absorbed yet. The next section breaks down exactly what's driving this shift in language and why it may be the clearest signal yet of where policy is heading next. Words rarely change without a reason, and this one has a clear one hiding just beneath the surface. To understand why balanced became tilted, you have to look at what's been quietly accumulating in economic data over the past several weeks. Data that individually looked unremarkable, but together tells a more consistent story. Start with employment. Job growth has technically remained positive, but the pace has slowed for 3 consecutive reporting periods. Each report on its own could be dismissed as noise. 3 in a row starts to look like a trend. Alongside that, the number of hours worked per employee has been quietly declining. A detail that rarely makes headlines, but is often watched closely by economists as an early signal. Companies tend to cut hours before they cut headcount. It's a softer, quieter warning sign that shows up in the data long before layoffs make the news. Layer on top of that a manufacturing sector that has spent months hovering right at the line between expansion and contraction, dipping below it more often than above it in recent readings. None of these signals alone would be enough to justify a shift in official language. But taken together, they form a pattern that policymakers are clearly watching. And that pattern is what appears to have driven this week's change in wording. There's a nuance here worth sitting with. Officials rarely announce a policy shift directly. Doing so would risk shaking confidence or appearing reactive to short-term data. Instead, shifts get introduced gradually, often through exactly this kind of careful language adjustment. It allows markets to begin pricing in a change before it's ever officially confirmed, softening the impact when the real decision eventually arrives. This is precisely why traders who read these statements closely reacted the way they did. They aren't reacting to the word itself. They're reacting to what the word implies about the data policymakers are seeing that hasn't been fully published yet. In many cases, officials have access to preliminary figures and internal forecasts before the public does. A subtle shift in language is often the first visible clue that something in that internal data has changed. This is where the connection to gold becomes clear. Precious metals tend to move in anticipation of interest rate policy, not in reaction to it. By the time a rate cut is officially announced, much of the move has often already happened. Traders who catch signals like this wording shift early are positioning ahead of the broader market, and that early positioning is exactly what showed up in this week's price action. It's worth being careful here, too. A single word change is not a guarantee of what comes next. Language shifts have, on occasion, been walked back or clarified in later statements. Policymakers sometimes test how markets react to subtle changes before committing to anything more concrete. This could be exactly that, a controlled signal, not a locked-in decision. Still, the pattern matters. This particular shift, from balanced to tilted, has historically preceded policy changes within 1 to 2 meeting cycles. In past instances where similar language adjustments occurred, that history doesn't guarantee the same outcome this time, but it's precisely why traders take these small details so seriously. The next section looks at how gold and silver have historically responded to this kind of early signal, and what that history suggests about where prices could be headed if this pattern holds. Markets have a memory, even when headlines don't. And when you look back at moments where subtle language shifts like this one have appeared in official statements before, a pattern starts to emerge, one that helps explain why gold moved as quickly as it did this week. In prior instances where cautious language gave way to more pointed risk language, gold prices tended to build gains steadily over the following 6 to 8 weeks, rather than spiking all at once. This isn't the kind of signal that produces a single dramatic day. It's the kind that shifts sentiment gradually as more traders notice the same detail and begin adjusting their positioning in smaller, layered moves. That's consistent with what's happened so far this week, a meaningful move, but not a chaotic one. Silver's behavior in these situations tends to be more exaggerated. As the more volatile of the two metals, it often lags gold slightly in the first day or two before catching up sharply once broader market sentiment confirms the shift. That pattern appears to be playing out again here, with silver's move accelerating in the hours after gold's initial breakout. There's a reasonable case for why this happens. Gold tends to attract more institutional attention, large funds and central banks that react methodically to policy language. Silver, with its heavier retail trading base and its ties to industrial demand, often takes a little longer to reflect the same shift but moves harder once it does. None of this means the outcome is guaranteed. It's important to stay grounded here. A wording change is a signal, not a certainty. Policymakers could reintroduce more cautious language in the next statement if incoming data improves. Inflation figures due out in the coming weeks could complicate the picture entirely, especially if they come in hotter than expected. A stronger than anticipated print could easily reverse some of the sentiment currently building in precious metals, since renewed inflation concern tends to work against the case for cuts. There's also the question of how other central banks respond. Policy shifts rarely happen in isolation. If other major economies signal a different direction in the coming weeks, it could complicate how this domestic shift translates into currency and metals pricing. Gold and silver don't move in a vacuum. They respond to a web of global policy signals, not just one. What can be said with more confidence is this: the language shift itself is real, it's documented, and it lines up with a broader pattern of softening economic data that's been building for weeks. Whether that pattern continues to build or gets interrupted by new information is something only the coming weeks will reveal. For now, what this moment illustrates is something bigger than gold or silver alone. It's a reminder that some of the most important signals in financial markets aren't found in dramatic headlines. They're found in 6-letter word changes, buried in the third paragraph of a document most people will never read in full. Those who take the time to notice them are often the ones positioned earliest for what comes next. Whether this particular shift marks the beginning of a longer move in precious metals or simply one data point among many still to come, one thing is clear. The message underneath the official language is becoming harder to ignore. And for anyone paying close attention, that message arrived well before any formal announcement ever will.